Raunak Onkar joins us, Head of Research Fund Manager with PPFAS Mutual Funds, and this has been just one big resounding success story in the Indian mutual fund industry. Not once upon a time, I think was it 2014 you launched?
13.
13, chalo ek saal, not bad. Abhi tak buddha nahi hua, I still remember. Memory is working for me. And your AUM has gone, which started with almost 150 crores, it's now at 75,000 crore.
Yeah.
So 13 years, what's been the CAGR return?
It's about 19%, 19.
A lot of small caps are given returns which are higher than that.
I agree.
So tell us where you think the markets are headed. Do you think 20% return, which you've given in since inception, can that return come from these levels also for next 5 years?
Very hard to sustain, Nikunj. Thank you for having me today. If you see today, the valuations are at a different level. So when we started in 2013, you remember that it was a range-bound kind of a market. You had a lot of a couple of flat years just after the run-up from the global financial crisis. And at that time, it was good to find ideas which were reasonably valued and had some growth trajectory to them. But I think the market is totally different today. We are seeing many sectors being bid up in expectations of future growth, which is coming in. I don't know if it will come or not, but mostly people are bidding up stocks based on order books. Some are bidding in terms of the sector doing well. Some are doing the promise of this particular industry doing well. And valuations are no longer at the same place. So I don't think we can expect a very high rate of return. But yeah, we'll wait and see how much returns we can earn in the future.
You're a true believer in, as a fund house, in value. Buy something which is cheap, which is ugly to eyes, buy something where there is value. So where is value according to you in this market? Because your fund right now has Coal India and also HDFC Bank, two very different businesses.
So Nikunj, if you see where is value today, I'll tell you what we are doing. That will give you an indication of where we think the value is. Today, we think the private sector bank ecosystem is relatively reasonably priced as compared to general market. At the same time, it's also close to about 20% of the overall portfolio. So we are betting on that. If you look at Coal India, you mentioned the power theme itself is interesting, but there are different companies where we think are reasonably priced, which is Power Grid or even Coal India or even a bit of IEX that we own, which are decent in businesses to own. There are other better companies to own, but the valuations have gone up quite a lot. If you look at the international holdings we have the Alphabet, Microsoft, Amazon, and Meta, which are also reasonably priced companies, some of them, and they're also growing quite well despite the size of these businesses. Domestically, again, when you see some of the things that we have sold would be about the capital market intermediary companies like brokers or AMCs, where because the cyclical businesses, it's very hard to sustain the kind of momentum we see. And it's very hard to then actually find stocks. So we are sitting about 16% of the portfolio in cash at the moment. Maybe we will find a few good ideas to invest going ahead.
Interesting way to look at things. But what are the other big themes that you're watching out for? Hi, Raunak, Anisha, this side. Energy transition is something, of course, that has been picked up by a lot of fund houses, but the valuations have run up as well. What do you do with some of these power stocks, the energy themes, even EVs for that matter?
I think some of these businesses are very good to understand today because the transition is actually happening at quite a rapid pace. With the cost of batteries falling, and at the same time, the commodity costs of other things are also normalizing for a while. You're actually seeing the demand offtake now as compared to what we were talking about, say, 5-6 years back, where everybody had a goal towards reducing the emissions across the world. Now, all these countries are coming and developing their grids. You're seeing renewable energy picking up. So all of these themes are playing at, I think, probably the max speed that they would have anticipated. And also China is helping a lot in terms of keeping the costs of all these things low. So we cannot say that we are benefiting from the overcapacity in some other country, but at the same time, the cost curve of technology itself has come down. So I think at the rapid pace at which we are growing, some of the traditional industries have not caught up to that. So if you want to build a power grid, you may need a lot of iron and steel and even cables and other power equipment. Those industries may not have the same capacity expansion as the other renewable sector or battery sector has shown. So there is a pull and a push at both these ends. And I think the dynamics has shifted towards this sector, which was supposed to be low growth, stable utility kind of business, is now seen as a high growth industry.
Top holdings continues to be HDFC Bank, at least in the flexi cap, and that's what I'm reading right now. Maintaining the faith in their financial pack, because ICICI Bank, Axis Bank, Kotak Bank, you have all of those, and unfortunately they've been underperformers.
Which is fine. So underperformance will happen from time to time. At the moment, see, we always have a challenge of whether we are buying something at a reasonable price that we like. And at the time, we realize that these banks are very strong consumer franchises. They have been well managed over the past several years of operation that they have had. At the same time, you will see unique things like having different fee generating businesses part of the entire entity. So it's fine. Sometimes they'll underperform, but at the same time, if the country has to grow, the GDP has to grow, the industry will also need credit growth coming from some places. And as credit growth continues, banks is one of the beneficiary to that trend in the long run. So it may sound a very simplistic trend, but at the same time, these are very strong network effect businesses where you can actually find a lot of competitive advantage in some of these companies, not just on the fee income side, but even at the scale at which they operate across the country.
Raunak, curious to know, where is it that you've actually reduced exposure, if at all?
So I mentioned earlier, we sold a little bit of the capital market intermediaries, which are brokers or AMCs. See, again, these companies are linked to the capital markets. They can become extremely cyclical. And as the markets have seen a one-way trend, these companies' valuations have also caught up in our view. So we have trimmed those positions in the past few months.
Point taken. What about pharma as a pack and consumption? Because pharma again was underperforming, but now at least as far as the earnings season are concerned and the commentary coming in, it looks like it's a space to be in. What's your take?
So in pharma, we have always maintained a basket approach. It's probably because of our lack of understanding of which one company might do very, very well. Despite tracking this sector for a while, we have realized that if there is a hiccup in the company's operations, like an FDA warning comes or some product portfolio does not do well, we realize that we will probably choose some companies which are export oriented. And at the same time, these companies also have a diversified mix of products. And that will help them at least take care of the cyclicality of some of these subsegments. So we have a basket approach in pharma. And in consumer, what we realized was the valuations have been so stretched for across the board. Only one company met our filter of valuation, that was ITC, and we have been holding on to it since the COVID days.
Let's look at pockets where right now there is this entire vibrancy which is related with what is happening to the consumption economy, capex economy. Whether it is industrial, whether it is manufacturing, or what essentially is happening in the entire export theme. How realistic is this entire theme according to you? Do you think somewhere some of the manufacturing and capital goods stocks are running ahead of themselves?
Many of them are, and they have been for a while. So especially right after COVID happened, some of the expectations in the capex intensive industries actually has been running far ahead of expectations. At the same time, we are seeing the growth catching up over a period of time. So I think the valuations have moved up much faster, but there is definitely demand growth. So it's not necessary that these are hollow numbers. The earnings will come over a period of time, but at what price point you will have to enter, those valuations are not very attractive at the moment.
So we started with this entire question on returns, that 19-20% returns on a CAGR basis will be tough to generate. Equity historically has given returns which are 2 to 3% higher than what the nominal GDP is. So if nominal GDP is 10-11%, can one assume that next 5 years the CAGR return could be 12 to 13 or 14 to 15%?
Over a long term, I think that should be achievable. But at the same time, it depends on what portfolio you have. So if you have a portfolio of all the fancy sectors today, maybe the return can also be negative. So I think investors have to be very careful what they buy, when they buy, and what price they pay for all these opportunities. And you might get lucky in 1 or 2 ideas, but at the same time, the portfolio might suffer if you have chosen all the fancy sectors and themes at the moment.
On that note, we let you go. Thank you so much for making time and speaking with us today. So that's the view coming in from PPFAS Mutual Fund. But for now,
if you like this video, then like, share and subscribe to ET Now.